The Hedgeless Horseman here. It's the 22nd September of 2022. Today was a quite boring market day. Gold, silver kind of unchanged. Yada yada yada, same noise, different day. Juniors, I think, were up on the day in the start and then the down, something like that. I mean, it's even though gold and silver actually ended up. Poor sentiment reigns supreme. We've seen this with juniors and results, etc. You have to have really, really good results in order to have anyone there to buy, there to be greedy. There's not a lot of dry powder around right now. So I mean, in light of, for example, you probably have seen line 1 did a raise at 77 cents, and line 1 kept on falling today. I think it was down around 12%, at least for a while. Might have turned around a bit in the end. And you can see, I mean, everybody's up in arms, getting pissed. Western Alaska, I'll get to that later, released very good drill results, and that stock ended down 20%. Again, it's like frustrating, yes, but the thing is, the important thing is that right now, during this, over 2-year-long correction, people are starting to really have short tempers. You see anger, frustration, people get pissed off. There was one guy on Twitter who basically, after this line 1 race, when it first, I think it went down like 16% on the day of the news or something, and it kept going today. It's like people have had it. And it's not based on, when people sell out, walk away from this sector, it's at least during bottoms. It has nothing to do really with the future. It has all to do with the past. And, one day something comes along that breaks the camel's back. So during these lows here, I mean, there will almost be no one left. Everybody, or at least 95%, will have their emotions get the best of them and will sell out. They will walk away, sell out, find another sector, see their portfolio down, let's say 60%. They typically bought in high, they never buy in low, and they always sell low. So they only have, let's say, poor experience from the market, because they always get in late after the move has already started. They get in closer to the top after it's been whatever sector has been going up for 1, 2, 3 years. That's when they buy in, because they see the past looks bright, they project that into the future, while in reality, again, 2 years into an uptrend is 1 year closer to the next bear trend, if you compare it to buying 1 year after an uptrend, etc., or after an uptrend has started. So I mean, it's literally our job. I mean, I'm kind of amused by it right now, because if you understand the market, how it works, it becomes very hard to take it personally, because the same reasons that get, or the flip side of the same reasons that people sell low is why they will buy your stocks higher when we're in an uptrend. So try to be detached. I mean, I'm kind of amused by what I'm seeing right now, because again, I know that it's emotions that get people to sell at bottoms. It's emotions that get people to sell at near highs. It's not because they don't buy the highs because they see a great opportunity. They only see momentum and greed. And right now they see momentum down and fear. So when you understand that, and that sentiment always changes, etc., it's like, you should really be amused. I mean, the worse the sentiment gets, the cheaper the stocks will become. They will go lower simply because more and more negative emotions keeps piling on, and more can't take it. I mean, some guy might have, held on for 2 years in a downtrend, but on day, 2 years and 30 days more, he can't take it anymore. So he sells, which brings down the price even further, and that gets someone else who held out up until he held out to sell, etc. So it's a negative spiral right now. So I mean, when I see, and I'm retweeted, Barron's out with an article, I think it was Barron's or New York Times, like, gold is not a safe haven anymore. It's like, that is good, because every additional negative feedback or news, etc., and price action will get people more negative. They will be even more irrational. Nobody can look at the valuations right now and say that they're going to stay this low. They are unsustainably low. The valuations are absolutely crazy in the junior space. And that's not because the market is rational. It's because it's extremely irrational right now. So when somebody sells because of negative emotions, that is the best reason for a buyer to buy. So when you understand that, you should really applaud it, because it's like, nothing is going to change the fact that sentiment will change. Nothing in this world is going to change the fact that sentiment will change. Not because Barron says it will, gold has lost its safe haven, not because someone says, these stocks will never go up, etc., etc. You want people to sell based on emotions, because that's the best way to make sure that they're selling for bad reasons, that they're giving away free upside. It's absolute best thing. So when you see negative sentiment, when we're already this cheap in this sector, you should really take advantage of it. And I'll go into it, more on what I call opportunity arbitrage. Anyway, so it's like, okay, what's happening now? Inflation is up, higher cost to build a mine. That's negative, obviously, if you don't really already have a mine. I mean, the OPEX is probably up because labor and fuel, etc., is up. But it's like, it's harder. It costs more and more to build a mine. So you would need to raise even more capital. Rates are also up. Higher cost to finance a mine. And the sentiment is atrocious right now. Valuations are very, very, very extremely low, and nobody wants to buy into this sector. So it's higher cost for equity financing. Everything of this leads to less and slower supply coming online, which is, of course, Rick Rule's saying, and other people as well probably, bear markets are the authors of bull markets, and bull markets are the authors of bear markets. It's like, take lithium, for example. Price has been skyrocketing last 1-2 years. I haven't looked at many, but the few economic studies I've looked at for junior lithium companies, they are absurdly profitable, these projects, at these lithium prices. And, I listened to, I don't know who it was, who talked about, lithium, and he that there's, maybe it was actually Robert Friedland. This was like 1-2 years ago, I think. But anyway, he says, like, there's going to be so much supply brought on. And obviously it appears that his bearishness for lithium has been kind of wrong. I guess either supply didn't come on quick enough, or demand simply, was way higher than he thought it would be in this short time span. Anyway, it's like, do you think we're closer to, given that lithium miners have gone up several hundreds of percent, lithium has gone up several hundreds of percent. Every lithium project on Earth pretty much is, I think, very economical right now. Obviously, that's going to lead to everyone that can is going to build a lithium mine. So supply is going to get jacked up in the coming years, for sure. And we might be going into a global depression, or a global recession at least. So it's like, you're not early in that game. That is not early, even though lithium might have. I mean, I've seen some people talk about you need, I don't know, 30 or 300 more lithium mines or whatever, whatever. That might be the case. I'm not saying that lithium has a very poor future or anything like that, but you for sure are not early. When the whole sector is printing money, everybody and you see juniors all the time out there switching to battery metals and picking up lithium projects. And lithium is not even a scarce resource. I remember Brent Cook saying that there's no shortage of lithium. Lithium is, I guess, kind of like a salt. I mean, it's everywhere in the Earth crust, basically. So it's not even that hard to find lithium deposits. So it's like, is that the business of the future? I mean, fast forward five years or so, I don't think the lithium miners will be making the bank they're doing now. No, I personally think like I missed the big move. It can of course go higher, but nothing is more profitable than when you grab a sector at its lows. And just the first leg up, for example, is probably in a sector might bring you better rewards than lithium mining is gonna do in the next 3 to 5 years, even though it might go higher. So anyways, like inflation up, higher cost to build a mine, yada yada yada. So supply, and especially again in the gold silver sector, because that's the crappiest sectors there is in terms of sentiment and valuations. Meanwhile, these are just some tweets today. Here's one. So I mean I can't vouch for this, but Director of Product Bullion Reserve. Okay, I'm assuming this is legit. Update from a major refinery. We are in an indefinite delay for silver kilobars due to extraordinary market demand. Future guys remains in the clouds. She talks about paper silver. Physical frenzy remains on the ground. Okay. Another one, gold in China trading at a huge premium to international prices as revival in demand outstrips the country's imports. Premiums are more than $43 per ounce over their London equivalent, the highest since 2019 according to data from the World Gold Council. So, okay, I don't know where, well, major refiners, so I guess that's international demand. Okay, silver demand, physical frenzy, physical silver is very much in demand, contrary to the price of paper silver and contrary to any silver juniors valuation. Gold, especially in the East, obviously up, trading at a pretty nice premium. I mean, highest since 2019. I guess that's here. So basically highest, around highest in 5 years. What does that say about demand there? India's silver imports skyrocketing. Very contrary to the price of paper USD silver and silver juniors. Another one, you may wonder why the paper price is falling as demand for physical silver is soaring, not to blah blah blah. Here is the COMEX silver also in crisis. I mean, look, it's gone from over 150 million to I think it's down to 45 or something. So 66% of registered stock in the COMEX has left since the beginning of 2021. That's a drain of physical. Yeah, here it says, okay, 46. I don't think actually that's updated today. It might be. I saw some number that was actually a bit lower, like 44 or something. Anyways, like, what does this tell us? To me, it suggests that the paper price of silver is not balancing this market. There are more people willing to buy silver at these prices than willing to sell prices. And you can obviously set whatever paper silver price you want, as long as you have inventory. I can start a car dealership, trading cars. Let's say I start with 100 cars. I have a price at $10,000 per car or $8,000 per car, and let's say $8,000 per car. And I see constantly people buying more than selling to me, meaning that more people think $8,000 for that car or those cars is cheap relative to, more people want to buy at 8,000 than sell at 8,000. So I can have those low prices on that car that does not balance the market as long as I have cars to sell. I can't have a marketing cars if I've sold out every car because everyone bought every car for 8,000 and nobody was willing to sell cars for 8,000 back to me. So this is obviously pointing. I mean, there's the silver here refinery, huge demand, apparently huge or big premium in China for gold, which says that the price in the West is too low. India importing silver as fast as they can. I mean, these are not small numbers, 1,800 tons. COMEX silver is leaving the vaults. And now we get into the pressing market. This is, I mean, who would buy this? I mean, we think that it sucks now in the juniors. We've had a downtrend for about 2 years. This was way longer, went way lower. I mean, who at this point, if you bought in here, who believes that this can ever change? Nobody. Nobody had seen any real evidence of this market ever being able to go up. This is Bear Creek Mining, my junior sentiment proxy or junior proxy. Almost nobody, maybe we're here now. Imagine how few that are going to be able to stick it out for another year as the future returns go exponential. And that was obviously, I blocked out the rest of the graph. This was the low early 2016, and after that it went up 600, topped at 644%. Obviously, you, in hindsight, you should have been willing to wait on that return for years. I mean, if you bought this low here, that's 100% in 2 years or whatever. That's really good. I mean, nobody is out there looking for it, even though it's like my personal goal is to compound at an average 50% per year. That's a very ambitious goal. But if you ask people and look at how they invest, nobody thinks that's good enough. And still under 5% beat the market. Why? Because everyone is too impatient and too greedy. People are looking for opportunities to go up 100% within a month, even though that almost never happens. At least you can't replicate it. But to have more patience and common sense than the market and get a 50% return, I think that is actually doable. Anyway, and I was going to talk about opportunity arbitrage, because like now, for example, and it pains me to see that people are hurting so much, and it pains me to keep saying it's like nobody should sell this low, and when it goes lower, I know that's like people who have not been a part of every bottom since the bottom in 2015, like I have. If you're used to buying the tops, you won't believe me. You will believe me less and less the lower this goes, and I still say, you would be stupid to sell. You would be stupid to sell because future returns are going exponential. I know that's true, but it pains me because yes, some might believe it for a while, or like yes, you watch one of my videos and then this junior sector goes down 20% the next week, and you're like, this guy's full of shit. Should have bought him by now. He's talking about future returns. All I see is an endless stream of, paper losses. But it's supposed to feel like that. This market will turn when everyone has given up hope that it ever will. Like at this point in time, which is here. This is the weekly chart. This is the daily. So the worse this feels and gets, the closer we are to the bottom. So, I mean, this is really an opportunity of a lifetime, I think. Again, it's like if you want some evidence of that, how, the valuations don't match up, just look at the actual demand out there for these metals. gold and silver, especially from the east, and those are not small quantities. And obviously, if the price would have been fairly valued at the COMEX, you wouldn't see a drain like this right now. So this is unsustainable, obviously, or at least the trend is unsustainable, because I mean, you can see here, I think this is around the bottom of 2015-16. The vaults were nearly empty, and we're rushing towards that level right now. We're down at 46 or something. I mean, it has dropped from 70 to 46 in just a few months. This can't go on forever. This kind of imbalance cannot go on forever. Otherwise, they will run out of silver stock. And that's gonna, Jesus. I mean, we've seen the nickel short squeeze. So, I mean, if you just look at the supply-demand picture out there for the actual physical stuff, it's obviously bullish. But you don't see any trace of that in the junior valuations. The juniors, like Bear Creek, are trading. I mean, this is kind of cool. Bear Creek has actually made. I think it's actually a bit. It touched a bit low. Maybe the same bottom. Whatever. It's like it has reached the same bottom level, or actually slightly below. I mean, that's like a record low since at least 2007, 2004. That's an 18-year low. And this is where people are throwing in the towel. And if this goes even lower, even more will sell. And I mean, again, it's like the future expected returns have been going absolutely bananas last 2-3 months. Absolutely bananas. The lower this goes, not Bear Creek in particular, I don't typically like that too much, but I think it's a very good indicator, sentiment proxy. This is going bananas. Selling just again gets worse and worse and worse and worse, because every week that passes, we get closer to the actual uptrend, and the lower it goes, the higher the future returns are in that uptrend when it starts. But I want to touch on why you should not fear. I mean, you should really love volatility. What is volatility? Okay, huge price swings. What gets people to walk away from this sector? Easily 95% of people don't make any money in this sector. I mean, that goes for the broader market, like 1 in every 20 people can beat an index. In this sector, I think it's way lower. It might actually be lower than that. Let's say 2% can actually beat the junior sector in the long run. Why? It's so volatile. Okay, but volatility, if you ask Warren Buffett, etc., they say that, and Peter Lynch, volatility, they love volatility. Why? Because they are not emotional investors. If you see this chart, it should be bloody obvious that you can make huge amounts of money in a volatile sector. You don't even need precision at all. You could just, let's say, I'm buying every time it goes below this line and buy all the way down. You would make money doing that. And let's say you wait and sell every time it has to hit this level or whatever. It's pretty bloody obvious that you can make money in a volatile sector. And you can make a lot of money in a volatile sector. Because if you're a part of one of these bottoms, and you can see that in, I think it's in Pilbara Minerals, for example, lithium. Absolutely destroyed lithium sentiment. The stock was down, I think, like 92%, 93%. Went up 3,600%. You could have bought all the way down. I mean, this was already cheap, yada, yada, yada. 600% returns from this level. 1,370 returns from this level. 3,620. If you had 5% of your portfolio left and you caught one of these bottoms, you would make money. Not only make your money back. If you had $5,000 left after invested $100,000, you would make money. You would have more than $100,000. So it's absolutely volatile markets. That's what why I'm saying that. I mean, when you see sentiment get worse and worse, people are just selling because of negative emotion. So this is the best layup. This is the best kind of environment you want as a buyer. Let's say in the case of Bear Creek Mining that we pretty much can be sure that juniors are going to hit this level again at the next sentiment peak. Let's say you have 3 stocks to invest in, these 3, and they're trading at different expected valuations. Let's say the risk profile, etc., differs. So this is like expected returns of 90, this 163, this 400%. Time passes and you just sit put. Okay, time passes, and now fast forward 2 months, now the valuations have changed for whatever reason. So this purple here has less future expected returns. It's not as cheap anymore. Yellow is not as cheap anymore, but blue suddenly became a lot cheaper. Obviously you could value trade, or let's call it value trading. You could sell some of this and buy this. That will boost your future returns. And even if we came in a scenario like, let's say this actually. So, wait, like this. So you bought stocks here, these 3 stocks. At this point in time, you're in the red in all of them. Let's say this is minus 40%, this is minus 50%, this is minus 60%. Nothing really has changed for the company. The value has not really gone down, but prices have gone down. Why? Because people sell based on emotions. People feel even worse about this sector. People are disgusted with the price performance of the stocks and sectors in general. But people are more disgusted with these stocks for whatever reason. You could obviously, in that case, even though you're down on all 3, down a lot, you could obviously sell some of this, maybe sell the whole position and spread it into these 2. And let's say the future returns in this case, average returns like 500%. You have to be down an enormous amount of money. If you're down 60%, you're going to make a big profit when we get back here. If you're down 60, or let's say you're down 66%, so you need 200% to make your money back. But expected returns in these ones that, for whatever reason, let's say because of negative sentiment, everybody hits these stocks in particular, you bought more of that from this. So you would need to be down 66%, or 66% down would not even be enough. That's why I kind of like to have these, let's say I don't want to be all in a stock. I want to be able to take advantage of what the opportunities the market gives me. I don't try to predict movements really. I don't try to predict a trade. I don't trade really. I just come to the market every day and see what Mr. Market is giving me. I let the opportunities come to me. So if I did nothing, if I bought 10 stocks, did nothing, came back 2 months later, I was down in every stock, let's say, all the way from 20% to 70%. I could sell some of the minus 20%. Take a 20% loss, buy more in the ones that are down 70%, assuming that value has not cratered. Assuming the price to value gap has expanded. So even though it doesn't look like my portfolio is doing better, because it's still down the same amount. If my portfolio went from $10,000 down to $6,000, and I reshuffled my whole portfolio, my portfolio would obviously still be worth $6,000. So nobody can see it right there and then that my portfolio has gotten better. Why has it gotten better? Because the future expected returns have gotten better. Investing is about the future. It has nothing to do with the past. Whatever you're down in a stock or down in your portfolio should not come in as a factor at all. So if I'm let's say I'm down 60% in a portfolio, which has an expected return of 200%. So I know that pretty much I'm gonna make money in this when it turns around. Even though I'm down 60% now, I'm gonna, or let's say it's gonna go up 300%. So even though I'm down 60% now, it's gonna go up 300%. But if I take that 4,000, let's say, I have left and put it in stuff that is gonna go up 400%. Obviously, my portfolio will have higher expected returns, even though nothing happened during the time I actually reshuffled it. It's just that the future returns have differed. And let's say they fall 20% more. Let's say I own 5 stocks now, 2 are down 20% more, 3 are down 40% more. And let's say what I have left is like, I don't know, let's say $3,000. But then I can reshuffle again, and maybe some stocks will be down so much that the future expected returns will be like, when Bear Creek really gets rolling, 600%. If I have $2,000 left, I'm gonna still make money. So I would, even if I'm down 80% at that point, I will make money at going into the next sentiment peak. But what do people do when that happens? If you're down 80%, what do people do? They sell out, of course. So the very opportunities in front of them, if they paid attention, that would get them out of their paper loss in the future, they're selling those. So they're walking away with, let's say, minus 50, 60, 70, 80% losses. And are going to find, the sector that works. Go and buy lithium right now, for example, where we're much closer to a top, I think, than any sort of like immense rally. That's what 95% do. They cannot stand it anymore. I mean, it's like pretty obvious. I mean, the worse this gets in the past, immediate past, the brighter the future is. So the curse is also the blessing. And if you sell here, what did that solve? It doesn't take away your paper loss, but it kind of ensures that you will not have a great future return. It's just, I mean, this is, I hope I'm, doing some public service here by pointing out stuff that is pretty obvious, but it's like so goddamn hard for people to do, because if the market is pissing in your face for 2 years, you think you are doing something wrong. No, it's Mr. Market is Mr. Market. It's a brain dead, emotional fear and greed monster most of the time. Now it's a fear monster. And just to have an example of, like right now, we know, for example, line 1, why you should pay attention to when the opportunities change. You should always be calm, cool, calm, and collected, and think what actually happened, not just the market reaction. What actually happened to the case? So let's say this was this purple stock here was line 1, and you had an expected return. You were expecting this is at least gonna return 164%. I mean, I think it's gonna return more than that, or at least the expected return is gonna be more than that, because I mean the sunk costs and all that. Whatever. Let's pretend it has a before this recent flush, it had a future expected return of 165%. Okay. That stock gets flushed because the private placement, and you can see in the room today everybody has their hair on fire. This market sucks. I remember that guy on Twitter saying I'm selling out, F this management team, F this stock, F juniors, what yada yada yada. So let's say he's sold out, and again it's like the dilution was 10%, excluding warrants. But let's say it's, let's put it at actual dilution, 12 when you include, I don't know, risk-adjusted dilution from warrants. Even though it's actually probably closer to Anyway, let's say 13.5%. That's your upside. That was diluted by 13.51%. Sure. And of course, I mean, money is supposed to create value. So yes, I mean, you get diluted, but it's also the dilution that's supposed to unlock the upside. So you actually get to the, fair value quicker, let's say. Well, let's say, I think line 1 is down like 30% or something in just last week at least. I know some probably were front running the private placement by selling. But let's take a step back. Okay, what does it mean? Okay, 10% dilution. Let's say 13.51 because of their warrants, etc. And you see this sell-off in line 1. Okay, what happened to the actual case? Should you just walk away? Should you sell because it feels even shittier? You're obviously, I mean, it has already happened. When it opened up minus, I don't know, 16% on the day of the announcement. So we can't go back in the future, obviously. And then we had more selling today. I would guess by people like, again, walking away in disgust. F this stock, F this sector, yada, yada, yada. But okay, we say that dilution is 13.5%, and the stock went down way more than 13.5. Let's say it went down 30%. So let's say the new valuation is down here. And even though, okay, this might not be the best example. Let's put it down here. So let's say even if we subtract the 10% or 13.55% dilution from the expected return, so it's not going to reach this level. With the new dilution, it's going to reach a valuation here. That is still 240% return. So that's better than before. Why? Because dilution was like 13.51%. The reaction, negative reaction, the amount of negative emotions brought it down way more than it should, way more than the dilution was, etc. So all of a sudden, yes, it feels shitty when it happens and you own the stock, so that position is more in the red. But at the same time, if you can identify this as, hey, okay, yeah, this sucks. My position in line 1 just went red or more red. But all of a sudden, maybe an opportunity presented itself. Maybe you have some other stock that's like, well, maybe you had this yellow stock here that had a expected return of 137. And all of a sudden, you find yourself at a bigger loss in line 1, but in line 1, all of a sudden, due to the negative emotions that brought it down more than it probably should, all of a sudden you have a 240% expected return opportunity. So you could sell this stock in that case and boost your future returns. That's basically, I would say, what I'm trying to do. That's why I'm 100% long all the time. I compare opportunities constantly with one another. So yes, sometimes or a lot of times, like now, for example, almost every stock I own is down since 2020. There are some examples like, Western Alaska, Goliath, and what is it like, Snowline, obviously. Yes, some of those are up. Some I don't think are, expensive anyway because of the poor sentiment environment. But anyways, like every stock out there has a different risk reward and expected return profile. That is what comes with volatility in an emotional sector. So if you like 10 stocks equally much, some go down 60%, some 30%, some 50%, some 80%, whatever. If you have a pretty good grasp of, what they should be down, and look at what they are down, you can see that they offer all of them offer unique risk rewards, unique expected returns, and margin of safety, what have you. So there is always something you can do, even if you're long, even if we're sitting in this 2-year downtrend. All stocks will not go down in the same manner or for the same reasons or rational reasons. Some stocks will be more disgusted in the eyes of the shareholders than others. Some will have problems that were not foreseen and they will get slammed by it. Again, when the last straw that breaks the camel's back comes along, one stock might absolutely plunge. And it might be right that it plunges maybe 20% or 10%, but let's say it goes down 30%. All of a sudden, a 20% price to value gap manifested itself. So it's like the market is brain dead right now. It's only driven by emotion, pretty much. You could see it in. This is going on quite long already. What time am I up to? 40 minutes already. Okay, I should really wrap this up. This was an example to show my value trading scenario. I'm gonna run this quickly. Let's say you start with a $15,000 portfolio. You invest in 3 different stocks, 5,000 in each. One goes down 30%, one goes down 20%, one goes down 25%. So this is what you have left in each stock, and you haven't done anything. Fast forward even more, we go even longer in the bear trend. This stock is now down a lot, 70%, I think. So it's only $1,500 left. Your portfolio, your position is only worth $1,500 from $5,000. This is cut in half, so it's down to 2,500 from 5,000. This is down, whatever, from 5,000 to 2,000. So your portfolio you have $6,000 left in your portfolio because as time passes, all these stocks were slammed. So you are minus 60%, and you think the world is ending, and you want to sell out of this sector because it's so shit it can never go up. Let's say actual value has not changed really. It could have gone down a bit or up, but let's say actual value is unchanged. The actual price that these stocks will hit one that has not changed. It's just that sentiment is taking the balloon is being pushed farther and farther below water, and it's gonna go up one day because no trend lasts forever. So you know that. What could you do? And you end up when you reach this point, you make a decision. You think about it like, okay, these stocks are, their values are the same still. Value, but prices have differed. So one stock is down much more than another one. One stock is down a bit more than one here. But you decide like, hey, the expected returns going forward in this one, because it's been so unfairly punished, let's say, for whatever reason, maybe a fund had to sell it. Maybe somebody owned this stock who needed to buy a house. Maybe he got a margin call. Maybe 1,000 different reasons. Maybe he just couldn't take it anymore and put in a market sell order. Whatever. So you reshuffle. You sell your $2,500 position and invest it in these two. And this was a pretty bad example. I couldn't get the scales right. So they should differ more, obviously. But anyway, it's like, hear me out here. So then let's say, again, you sold this position, put all the profits in these 2 other stocks, even Steven, so you have some diversification at least. Now let's say this one has an expected return of 200% and the other one less than 200%. In reality we should say like 300% and 200%. Regardless, let's say that they both have expected returns of 200%, whereas this has 150. That's the one you sold. So your expected returns going forward are 200%. Your expected portfolio value will in that case be 3 times 6,000, which is 18,000. Expected profit 3,000. So even though it sucked, one position is down 70%, one is cut in half, one is down, 60%, whatever. You're still gonna make money. Why? Because you actually identified that the opportunities had changed, so you used your currency purchasing power in this. Although it was down 50%, you didn't, go crying or anything like that, or just, was too lazy to look at stuff and were just, when it turns, it's gonna do well. Sure, I mean, in this scenario, every one of these stocks will go up. But this at least will have it. Well, this was a very bad example. It shouldn't have been 100% here for starters, and these scales don't add up at all. But anyway, I hope you get what I mean. It's like you can still you can work on your long-term portfolio all the time. Volatility is great. Volatility is superb. Because even if you're down in every stock, you can still set up your portfolio to have an even brighter future. I mean, anytime, let's say two identically good stocks, anytime they differ by 10%, one day some goes up 5%, and same day the other one goes down 5%. That's a 10% difference. You could sell your appreciating stock that's up 5% and buy the one that's down 5%. That's going to change your future returns, expected future returns. So I guess what I'm saying is like, don't throw in the towel. Don't hate this market. Embrace this pain. The more emotional people get, the better, because they're going to make more stupider and stupider decisions. And if you can see it for what it is, that's going to be great. Like Western Alaska, for example. It put out one of the absolutely best holes I've seen. 101 meters of almost 102 meters of 544. That's like bonanza grades, or at least very high grades. 48.8 meters of 680 grams per ton AG equivalent. And there's the typical 1 kilo intervals here as well. Obviously a stellar result. Market sold off 20%. Why? My guess is that hot money had been buying into this stock because the visuals were that exciting. I mean, it ran like this from the visuals alone. Okay, so people buy into this stock. It's like, okay, these assays, I'm going to get rich tomorrow, I'm going to get rich tomorrow, I'm going to get rich tomorrow. And like my hope was that it's like, if this grades 1 kilo, it graded 544, the long one, the 102 meter one. If this grades 1 kilo. It didn't grade 1 kilo, but it's still one of the best holes I've ever seen. But that is not enough in this market. Expectations were probably or obviously higher, and there's no buying power, and there's too many people who were just in it to get rich tomorrow. You know, the one that never beats the market. So okay, what is happening right here? You have impatience, you have greed, you have get rich quick. All of these things one can relate to. So you can explain it, and that's why you shouldn't hate on it, because if you just fast forward, what's going to happen? First of all, they hit more zones as well, so there's going to be more results. But anyway, and we are nearing the winter period in Alaska. Okay, so what happened to the case? This is one of, in my opinion, best exploration stories there is. They have a goal of reaching 45 million tons of very high-grade CRD mineralization for next year. They wired the deposits for 3 additional rigs. 39% of the company, I think, is owned by insiders. They're not jacking up their burn rate for no reason. this is, what appears to be a quite unique. It might be super large. I know they said that they have like a 6 kilometer trend to work with. If they have 1 kilometer of this type of mineralization, in the ballpark of what they've already hit, that would get them closer to 100 million ounces of AG equivalent, and would be similar to, similar to the deposit that Silvercrest has. And Silvercrest is around over 1 billion. It reached a peak valuation within the last 2 years of 2 billion. That's what Western Alaska could potentially have from 1 kilometer. And that trend is 6 kilometer that they have to explore. And that's one of the trends. There are some of these CRD systems that are up to 50 million tons. That's more than 10 times the size of Silvercrest. So, okay. Let's think let's be a bit rational and cool here. Okay, what happened? You can explain what happened. So you can't get pissed off. You can't get pissed off. Because if it's based on emotions, there's a way to take advantage of it. Because, okay, let's say that this is too cheap right now, based on, what you expect to have happened within 1, 2, 3 years. Maybe you expect this to be worth 600 million within 2 years. All of a sudden you get a 20% discount, which jacks up the future returns with like, let's say 80, 100%. That's if that's the case, that's a bloody big gift. 100% in like 2 years. In added, expected upside. So when you really understand the market and how it works, how people work, you're gonna stop being pissed and see it for what it is. I don't know where Western Alaska is gonna trade in the short term, whatever. I put in some bids today, for example. I think I got some at 291. Not a huge, ad, but it's like if Alaska turns today or tomorrow, fine, okay, I already got a pretty, sizable position. If this drops like 20% or 30% more, maybe I'll double my position. You know what I mean? I let the opportunities come to me. This is the beauty of volatility in a depressed sentiment environment. Because stuff that has no business trading at the level they're trading typically become even cheaper. So let's say I have Western Alaska. This, for the reasons I mentioned, like, the 100-meter intercept is already out. People are fearful. People are front running that, winter is coming, yada, yada, yada. So let's say it goes down 20%. And let's say I have the patience to know that, hey, the same people that are selling now are going to come back in 6 months when they have 5 rigs drilling. And they're going to hit more of this stuff. And this is a world-class system, etc., etc. I mean, you see what I mean? I hope you get what I'm saying here. It's like, don't take anything personal. Don't get pissed off by anything. If you start to have a victim mentality, you're gonna lose, because you're not thinking straight. I'm not pissed because I'm down 20% in Alaska and it's a pretty big position. I see it for what it is. I can understand what happened. I can understand. And in the future, maybe, okay, next time I'll do yada, 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 because you figure out how people work. But at the same time, I don't know how low Western Alaska is going to go. If it goes lower, the opportunity gets better. All else equal. So maybe that will lead to me selling something and buying more of Western Alaska. And all of a sudden, I turned what appeared to be a curse, meaning a falling price, to actually increase my long-term results. Because an opportunity manifested itself, and I took advantage of it by selling something else that had a lower expected value. So guess what I'm saying is, I hope what comes through is like, don't be discouraged, don't be alarmed, don't run around with your hair on fire. Watch how people behave. Every time you see emotions, somebody post an emotional yada yada, see it for what it is. That is not value investing. That is someone being emotional. And if there's a lot of negativity, for example, you can probably, see it for what it is. But the important thing, obviously, is like, don't buy everything and don't buy a stock just because everyone is negative on it. But take a step back and consider the long-term picture. What actually happened to the value of the story? What is going to happen with the next 1-2 years? And then compare it to the current sentiment and what the current sentiment has done with the pricing of the company. So it's not just either or. It's have a objective, try to have an objective view of the case. And then let the opportunities, which is basically the volatility based on sentiment and emotions, come to you. Don't curse at this market. See it for what it is. This volatility is why you can make a lot of money. Emotional selling is how you get the great future returns. When you think about it, it's pretty obvious. When you think about it, there's obviously a way to make money from this kind of volatility. Huge money, actually. But the trick is obviously not to be selling, juniors down here when they're like the cheapest they've been in 40 years. How is that going to help you? How is it going to help you if you're down 70% right now to walk away from, let's say, the best layup there is? And it doesn't matter. I mean, if you're down, if you bought the top here and you're down 70% across the board, that's already past. That's already past. Investing is about the future. You can start making better decisions today, and that's going to serve you for the rest of your life, and you're going to make that back. If you have an expected return of 8% and you get better at investing, better at controlling your emotions, better at taking advantage of other people's emotions, and you jack that expected compounding up to 15% or 12% from 8%, that has a huge difference in the long run. That added 4% per year, that is really, really good. That's going to get jacked up a lot. But I mean, again, from these levels, I mean, I believe me, I'm not expecting like 8% per year over the next 4 years. I'm expecting, heck do I know, 60% per year or something. Anyway, thanks for listening. Consider me biased if I talked about any stocks. I own Line 1, I own Western Alaska. They are sponsors of mine. Consider me biased. Do your own due diligence. Think for yourself. Don't blame anyone else for anything. Your losses and wins are up to you. Thanks for listening. Hit the like button. Bye.